Welcome to Wealth on Your Terms, the show where builders, unconventional thinkers share how they're creating wealth and freedom their way. I'm your host, Tobi, and today we have Elise Perryman, an award-winning banking executive who went from corporate boardrooms to building wealth as an entrepreneur. After a successful career as a banking executive, he's now the owner of multiple laundromats, a real estate investor, and someone who's built wealth across different arenas. So welcome to the podcast, Elise.
Thank you, Tobi.
And thanks for being here on
Very
this
welcome.
Saturday.
Thank you for having me.
Yeah. Do you want to give a quick TLDR about yourself? It could be something outside what I've said here.
Sure.
Or something that includes it, if you want. Yeah.
I'm a man, a jack of all trades, and master of none, as they say. So I started my career in analytics and developed into marketing, continued into analytics, transitioned to entrepreneurship, as you said, and the punchline, coming back a little bit into corporate, and along the way, thinking of how I can augment my portfolio and thinking about wealth transitioning, how I can create generational wealth. And so along the way, I looked at actually at product development, looked at real estate, looked at the laundromat business. So looked at a bunch of different things along the way, dabbled in quite a few things, as I say, jack of all trades, master of none. And now I have my feet in both the corporate and entrepreneurial world.
I love that, like the mix of both. We're going to dive into some of that very soon. So I like asking my guests this just so people understand where they're coming from. So growing up, what did you learn about money, success, work? What was that conditioning you have growing up?
First thing is I was very cheap. So
How cheap?
So if my mom would give me money, I would never spend my money, and I would always look for her to continue to spend hers on me or my brother to spend his on me, but I would never spend mine on me.
Wow.
I had, at the age of probably 6, had a garage sale that I organized, and of course my older brother, who is 10 years older, put a B in the garage to make it a garbage sale. So I've always had a knack for thinking about the longer term and thinking about dollars and cents. And work ethic, I definitely learned from my mom. She was a single mom. And she would be constantly taking care of us and making sure that we were provided for. So she worked at a bank. While I didn't know it at the time, I suspect she got laid off.
Oh, okay.
She then created her own business, and she went into the travel agency business. And then from there, she created a video. And I also see where I get my jack of all trades
She did mention
from.
Yeah.
So the store that she ended up creating was it started off as a beauty store. So it was, we had black beauty products and we had records. And it was in a neighborhood that, while that was good, it wasn't great. So then she added videos to the store. And so it was a mix of video stores, black beauty products, records, you name it, we had it. And that the work ethic that I saw her demonstrate is what I perpetuated in my life. And I had multiple jobs. And I always tell this to my kids who have not really worked yet, but I was constantly working, from door-to-door salesman to working in essentially a factory at a newspaper, to retail, to on the phones at a call center.
You've done it all.
Delivery driver. I did quite a few jobs.
No, you've done it all. And to think that you then climbed the corporate ladder, because you actually did climb the corporate ladder.
Yeah.
So you've done it all. But I feel like I'm also jack of all trades, master of none. And sometimes it scares me because people say it's bad to be that and it's good to like specialize in something. But what's your take on that?
I personally think everyone's journey is different. No two people are going to have the exact same journey, and your skill that you may want to be a specialist in, it may be a saturated market.
True.
And so if you're a specialist in a saturated market, that's not going to benefit you at all. You have to understand the environment in which you're operating and understand how you can best transition and evolve within that market. And having multiple skills will allow you to nothing seamless, but with less effort, glide and move throughout different things so that you are always, I don't want to say you're always busy, but you're always busy. You always have something that you can do because you are skilled, and you may not be a specialist, but you're skilled in many things. So I personally, unless you're a doctor or a dentist, I'm an advocate of having several skills because you never know when at any one time you may need to lean on one versus another.
That's actually right. That's accurate, especially with how things are trending now. It's like it's more challenging to predict the future. So you never know what skill might be needed in the future.
The most important skill, especially for young people, is the skill to learn. If you have the skill to learn and adapt, that to me is greater than any discipline, one specific discipline, because then you can navigate throughout different opportunities.
I agree. I agree with that take. So you spent over 2 decades, over 20 years in banking. You climbed the ladder. And what did you learn about just building wealth from there that you've now applied to outside?
The advantage, so when I started at the bank, I started on the retail side. I started actually in a branch. And so I had to obtain my mutual fund license to be able to sell mutual funds.
Oh, okay.
And so doing that enabled me to understand dollar cost averaging, which is when you are constantly buying, you are averaging out the cost of the highs and the lows. So you're not worrying about timing the market by dollar cost averaging, which is purchasing the same amount over a specific period of time. When the price is high, you buy less. When the price is low, you buy more. So that averages out your cost. So learned about dollar cost averaging, learned about the time value of money and the benefit of starting young versus old, in that when you compound the investing at a young age, doing that is so much more valuable than starting even with more money at a later age. People think, oh, I don't want to start now because I don't have a lot. It's a terrible, terrible thing to delay investing, even if it's only $50 a month, because that amount that you're investing now will have a significant ability to generate returns, especially if you put it into a tax-sheltered investment like an RSP or a TFSA. So those are some of the things that I definitely learned early on.
No, that's a good way to put it out there. I always tell people it's like you shouldn't wait till you're earning a large sum of money to start investing because you could miss out on a good investment right now. And then you're also building that habit. Some people wait till they're earning 100K, for example, per year to start investing, and they haven't built that habit of even saving or investing or knowing the type of investor they are and their risk level.
And I can't remember if it's Rich Dad, Poor Dad. I think that's where it's from, where I heard it first, and paying yourself first.
Yeah.
So you have to take a little bit off the top every time for you first, and you first is that investment portion, whether it's 5%, 10%, whatever it is, and then that helps you get on the path and the habit of saving.
Yeah, I agree. So let's move on to aside from like your corporate career, you also went into entrepreneurship. So you went into both real estate and laundromats. I'm curious why both avenues and what made you decide those were like great for you. Maybe we'll start with real estate first.
Sure. Chronologically, real estate would be first.
Okay.
So it was my sister-in-law, really. She had gone on a seminar and she came back all excited and she's like, hey, we should do this. And I was like, Sure. And so we started investing, my wife, my sister-in-law, and myself. And so at our peak, we had 11 doors. We had 3 triplexes, 2 condos. And the
In the GTA.
triplexes in the GTA.
Okay.
And the triplexes they're proper buildings as opposed to houses that are retrofitted for. So, yeah, and that the benefit of real estate cannot be, we cannot talk about it enough in terms of generating wealth, because that is how the wealthy people, even McDonald's is not a burger franchise. It is a real estate company. Like, that's how you generate wealth. And so we did that for quite a few years. Unfortunately, I got impatient because real estate it's a long game.
Yes.
And in the short term, you ideally should be cash flow positive. And so we were cash flow positive, and then we refinanced, and then we got a property manager. And by doing those things, we were cash flow neutral. But when you're cash flow neutral, the income that you generate on real estate is considered regular income. So you're being taxed at regular income on income that you're not really putting in your pockets because it's not cash flow.
Yeah.
And so for me, although we were building generational wealth and we were building that asset base, the impatience was on a day-to-day, year-to-year basis. I'm taking money out of my pocket, even if it's just considering the tax implications, taking money out of my pocket to pay for this because of how we restructured it. And it was those were significant assets. It didn't make sense. So we actually exited real estate, and that was the reason that we exited.
Then let me just take it back. So you said 11 doors. How did you get to, like, from 1 door to 11 doors? Did you always, like, maybe refinance, pull equity out, or what was the strategy?
Excellent question. And I have to actually remember this now. So the first set that we bought, we actually jumped in quite heavily because the 2 buildings were 2 triplexes side by side. And so we had 6 doors right away, our first purchase.
And that's like your first?
Yeah.
For you 3, it was your first real estate? That's
first
a bold
purchase,
move.
big building,
Yeah.
2 triplexes connected, 6 doors. And then the remaining, but what we did, and you could argue about how we did this as well, and I'd probably argue in hindsight that we didn't do it the greatest way. We didn't do it as a corporation. We did it as individuals. And so my wife and I bought one of the triplexes. My sister-in-law bought the other. We considered it all one investment, but we bought them separately. And then that's how we continued to acquire the remaining purchases, is we actually split the ownership because we weren't buying it through the corporation. We split the ownership. And so given that we all had good jobs at the time and the prices weren't what they are today, it was I would say easy, but we were able to get financing without refinancing to make a purchase.
Oh, that's interesting. Quick one, this podcast is about wealth on your terms. And for a lot of people, that includes real estate. I'm a licensed realtor in Ontario, and I help people think strategically about how real estate fits into their overall wealth plan, whether that be buying, investing, selling, renting, or just making smarter decisions. I'm going to be there to guide you through the numbers, ensure you understand the trade-offs and opportunity costs so you can make informed decisions with confidence. So if you're interested in real estate, check the link in the description box or show notes. And while we're at it, if you're finding value from this podcast, please don't forget to hit the like button and subscribe if you're watching on YouTube. And if you're listening on Spotify or Apple Podcasts, don't forget to hit the follow button and give us a 5-star review. It really goes a long way, and it ensures that we're able to put out more episodes for you. And I really appreciate it. Let's get back into the video. What would you have changed, like, in retrospect, regarding your real estate strategy or just that line of things?
Probably not buying individually and as a corporation, and then ensuring that all refinances went back into the company. By refinancing and taking cash out, what that did was you feel great in the moment, and you are able to do whatever you want with that, but you aren't able to continue growing the business the way it should. We didn't treat it as a business. That was the biggest thing, is we didn't treat it as a business. We treated it as investments. And while I won't say we treated them as individual investments necessarily, we kind of did.
Okay.
And so that would be the thing that I would change.
I like that because I think a lot of times when people get into real estate, they treat it as, I don't know what term to use, but not a business, but it's like more emotional. And then if you treat it as a business, that's when you can think logically, like you did, about the numbers and see if it makes sense or not, and then feel free to exit. But if there's that emotional connection where you're not treating it as a business, then sometimes you just make a lot of emotional moves in real estate, even if you consider it as an investment.
Yeah.
Yeah. No, that's good to know. So how did you then get into laundromats?
My bank got me into laundromats by telling me that it was time for me to go.
Okay.
So when I owned the real estate, in the basement of the buildings were coin operated machines.
Okay.
And I loved that business and said that one day I would love to scale this business. And I was actually, while I was working, was actually passively looking for laundromats, but it wasn't a big need, so nothing really happened. When I was let go and I had a huge chunk of change in my pocket, I said, okay, well, now let's actually do this for real. So let's make sure that we go out and find laundromats to actually sustain myself now.
Yeah.
And so that's how I got into laundromats.
Oh, okay. So what did you consider making your first purchase? Because it seems like you already had like at least some experience because of the washer and dryer units, washer and dryer units in your rental property. So how did you then make that move? Did you know someone who owned laundromats? Did you know someone in the business space? Or
No, I knew. So for good or bad, I'm the type of person that when I make my mind up on something, I just do it.
Same, yeah.
And so I made my mind up. I started looking. Anyone can look on, it's realtor.ca. Anyone can look and see what's available for sale. When you inquire, the selling agent will usually try to get their hooks into you.
Okay.
Because although you might not be interested in their laundromat, they can help navigate you to other laundromats.
Oh, okay.
And so that's what ended up happening with me is I inquired about one, the real estate agent, we connected, and then she started showing me other things. And the one that I really wanted was actually close to the one that I purchased. I had put in an offer. Everything was going great. It was worth a lot more than the one that I ended up purchasing. But at the last minute, they pulled out. And I'm glad they pulled out because that was in December 2019, and then COVID hit.
Yeah.
And it would, given the financing that I would have had on that business and the revenue drop, it would not have been fun. So it was very fortunate that they backed out. As you ask about the experience in acquiring and understanding laundromats, the machines that I had in the basement were, it almost gave me false hopes or false understanding because that's an extremely simple business when you only have two machines. When you scale that, you scale and you magnify the problems. So the first thing is you're now paying, unless you own the building, you're now paying rent for the business.
Sure.
You now have customers that aren't your tenants. You have security challenges. There's just a whole host of other things that come with it. And because my background is in finance, I was able to objectively look at the numbers to understand what made sense.
Okay.
And you have to do that with any business.
Yeah.
But with a cash business, it's even more important because there's often not great proof of what the business is doing. So you have to use clues like gas bills, like water bills, like electricity on top of what they say. And then you want to use a multiple. And a multiple is just if the net profit they're saying is 100,000, let's say, then a multiple of 4 would mean you'd buy it for $400,000. And so you want to think, well, again,
It's a good multiple.
so
Yeah.
anywhere for laundromats, I would say anywhere between 3.5 and 4.5. I typically try to stay around 4. And
Is there any reason why, or is that just like a good rule of thumb for laundromat businesses?
It's a good rule of thumb. The reason, so the actual reason is that means it takes 4 years to pay back your investment. And so the higher the multiple, the longer it takes to pay back your investment.
Yeah.
The higher the multiple, the easier the business should be. So it should be new machines. They probably have a card system. It's almost turnkey, which nothing is turnkey, but it's almost turnkey.
Yeah.
That would be your higher multiple. Your lower multiple of 3.5 would be the machines are older. There's going to be maintenance that they're not really reporting because they probably do it themselves. Yeah. There's, it's just, there's more, it looks like there's more challenges with it than with a 4 or a 4.5 type of store.
That makes sense. So you went from 1 laundromat to 3. Was it, after that 1, was it like really successful, or what made you then scale to 3?
No, it was the time. So bought in February 2020.
Okay.
COVID hit in March 2020. And so my revenues were depressed. And what they always say is buy in a recession or / depression. So I said, okay, well, let's double down. My revenues are down here, but that means they're down somewhere else. And you buy based on revenue. So if the revenues are down just because of COVID, then it's a great time to buy. So that's why I actually bought my second in the same year that I bought my first.
Oh, same year. Okay.
And then I bought my third the following year when we still hadn't fully recovered from COVID. So that's why I bought them when I did, was they were all clustered around what I suspected was a revenue dip.
And do you feel like it was a good decision just based on?
It was. The challenge, so the other important part, so there's, to profitability, there's 2 components. There's revenue and there's cost.
Yep.
The biggest cost component is your rent. And so I underestimated the impact that my leasing rent change would have on my bottom line. I have no idea to this day why I I won't say misunderstood, but did not properly account for the impact that it would have. But from a purchasing perspective, unequivocally the right thing to do. The third one that I bought, where the lease was properly structured, everything was fine, beautiful. Revenue went up just like it was supposed to, and so now worth more, even though I didn't really do that much to build it.
Yeah. So for your first one, was it like a triple net lease where you pay for utilities as well as just the space? Okay. Yeah. So yeah, things like that are not predictable. Makes sense. So I know you sold one. Is it the first one or?
Yes, yeah. I sold, and this is where not being emotional comes into play. So My first was my baby, and that was also the brand that I had used for the second, not really the third, but it was the brand that I carried with me.
Okay.
And so when I bought the first, they had the best machines, great customers, closest to home, and the most revenue. But it also, when I bought it, I actually doubled it in value because of the wash and fold component that I grew. So you were asking about add-ons.
Yeah.
Add-ons is the most prevalent add-on that a laundromat owner would leverage. And the benefit with wash and fold is the margins are high. So
Can you give me an example?
Someone comes in, does their own laundry. The washer costs $5, dryer costs $2, costs them $7. That same load would cost about $25 by us doing it. But what we're providing is we're providing convenience. All these things, giving back time. Yeah. Packaging, like all these wonderful things that the customer wouldn't get on their own. So they are usually different customers. The self-serve versus the full-serve customer, they are usually different customers. But that is the best way to grow the business because you don't need as many customers to generate much more revenue.
Sure.
The flip side is there is significant work associated with that. And so I had employees who would do the folding, but I also offered pickup and delivery service. And so I was doing pickup and deliveries, and I had corporate clients, and some were downtown and some all over the place. So there was a lot of driving, a lot of picking up. I did the washing, I would bring it back, the employees would fold. Depending on the volume, I would help fold. So it was a lot.
Wow.
And so to me, it was worth more sold than operating.
Okay.
And that was take the emotion out of the equation and say, well, let's just look at this objectively. And what I could have done is I could have had a step cost where I invest in a van and I invest in a driver. And then profitability goes down temporarily, but then the goal is to continue building. And then if the van and the driver are only 40 or 50% occupied in the beginning, the goal is to have them completely occupied to the point where you may need another van and driver. And so, and I would likely also have needed more employees to fold the more volume you generate.
Yeah.
So there are step costs wherein you have to acquire something or people, and there's that cost, and then the utilization goes down because you've increased capacity, and then at a certain point you increase utilization to the point where you probably need another step cost, and it goes down, so forth and so on. I didn't want to cross that barrier of the step cost, and so I said, now's the time.
But you at least double value. Yeah. And what was the time frame from?
5 years. So I bought in 2020 and sold this year.
That's good. If I'm looking for a laundromat, what's the typical price range? I know it would depend on location.
100%. There are multiple variations. So I'll say the price range, realistic price range first, and then I'll give you some criteria. Yeah. Realistic price range, I would say between 180 and $1 million.
That's a lot.
It's a very big range. Yes, it is.
Yeah.
And so what are the factors driving that? So the size of the location. At the end of the day, what drives that is the value that they're generating.
Yeah.
Because remember, I told you it's a multiple. So you're not going to pay 50 times the revenue or the profit for a location. You're still always going to be around the 4 multiple mark.
Okay.
And so the $1 million place just means it's generating $250,000 in profit.
Yeah.
The $200,000 place just means that it's generating about $50,000 in profit. So that's when you boil it down, that's what it is. But the factors that contribute to that differential in revenue will be things like the size and the quantity of machines, usually some wash and fold as well, any other things that they have, maybe dry cleaning,
Yeah.
any vending machines that they have, all of those different components that add to the revenue of the business.
Okay. And you also said you had kind of like B2B clients, so working with some clients, like corporate clients.
Yep.
Does that also add extra profit for you since they're a different client base?
No,
Or do
what
you,
it does is it adds consistency. And so with corporate clients, you excluding their cyclical nature, which you can understand and predict,
yeah.
you know that you're going to pick up Tom's Bakery or whatever this week, and you know that you're going to pick up so forth. So you know those things, and those are pretty steady versus the household, which may do it this week, find it's too expensive next week, and then come back. So the corporate clients provide consistency in your revenue stream.
Makes sense. So now you have two laundromats. If you were to acquire another type of business, would you also still be laundromats in this market, or would you be open to something else? I'm just curious.
So most other businesses, you have to, you either capital intensive or labor intensive. And some businesses are both. And so the laundromat is a capital intensive business in that you have to have a lot of machines to have a successful business versus having to have a lot of people or your own labor. Laundromats consistently rank as one of the top businesses because of that nature of it's capital intensive. You don't have to be there yourself all the time. You don't have to have many, if any, employees.
Yeah.
So given what I now know about laundromats and how intimate I am with the industry, I would say yes, if I were to buy another business, it would likely be another laundromat. What I would do, however, is I would stay clear of the wash and fold aspect, although that's where the margins are. As I said, that's where all the work as well is. And so I would be satisfied with a slightly lower revenue take. The multiple will still be the same, slightly small revenue take, with the knowledge that I could, do SEO, search engine optimization, and I could help grow the self-serve component that way, try to enhance customer experience by having machines working, those types of things. So I would look at the self-serve business versus the full-serve business.
That makes a lot of sense. So talking about, since you had that corporate experience and then the entrepreneurship experience, it seems like with your first laundromat, you were working in the business. So how was that experience for you?
So I have my MBA, and when I went to grad school, we did business cases.
Okay.
And a business case is there's a situation, and there's bosses, employees, and you understand and assess the situation, and you make a business recommendation as to what they should do going forward. And whenever we did an entrepreneurial business case, oftentimes the problem was the owner was operating as an operator versus a CEO. And so to your question, they were working in the business versus on the business. And as an outsider looking in, it's extremely easy to identify that and extremely easy to say, do not do that.
Yeah.
Work on the business, not in the business. I have that knowledge, and I still worked far too much in the business versus on the business. So, and I knew it at the time, but when you're trying to generate revenue and you're trying to minimize costs, and even though you know the right thing is to step back, hire someone to do the thing, and you do some other thing that will help generate more revenue, you oftentimes just get caught up in running the business versus thinking about how to be on the outside looking in and working on it.
So what would your advice be if there's like someone, a business person watching this podcast that feels like they're working in the business? What would your advice be? How did you take that step back?
See, the challenge is it's very situational.
True.
And so when you are extremely dependent on the revenue from your business, it's hard to instruct someone to take a step back, incur more costs in the short term. And it is a gamble. Everything's a gamble.
Yeah.
To incur more costs in the short term with the expectation that in the long term you will generate more, because there's no guarantee that you will generate more in the longer term. What I would say is, wherever possible, if you have a partner, if you don't need all of the revenue, getting help. And that's another problem with entrepreneurs, and I was extremely guilty of that myself. When you can do something, you do that something, versus, yes, I can do it, but my time is worth more, so I will pay somebody else to do it. Yeah. That's what should happen. That's what I would tell someone who is watching to do. But if you're extremely dependent on the revenue, and sometimes people love doing that thing as well.
Sure.
They may not love working on the business, but they love working in the business. Mm-hmm. Then it's hard. What you should do then is get someone to work on. Someone needs to be working on the business. Ideally, it's the business owner, but someone needs to work on the business. And so if you can't work on the business, you're too ingrained in it, find a partner, whether it's a life partner, whether it's a financial partner, find someone who can help to do that work on the business.
Yeah. It's interesting because for a lot of people, they say they want to leave corporates because they want to be free. They want that freedom, and then they pursue entrepreneurship. And a lot of times, especially in the early years, you sometimes work 24/7 versus corporates.
100%.
Yeah.
So did I feel more free when I had my laundromats? Absolutely.
Did you say you felt more free?
I felt more free.
Interesting.
100%.
Even while you were still working in the business. Why?
Because it's yours. Because your bosses are all the customers, but really, if you wanted to degrade your business, you didn't have to listen to your bosses.
True.
So you don't have to listen to anybody.
Yeah.
So you do have, and I didn't have hair. Working the corporate life, you're fearful, you want to fit in the mold. So you do the things that fit in the mold of whatever you think is appropriate, and you don't veer too far from that. When I became an entrepreneur, I was like, okay, I'm going to grow a beard, I'm going to grow my hair, I'm going to wear t-shirts, I'm going to wear whatever I want to wear, because it's me, it's my life. I don't have to account to anybody. While I felt freer in the beginning, to your point, the shackles started to appear.
Interesting.
And so
shackles appear even in entrepreneurship.
100%, because you are constantly working. And in a cash business, not only are you constantly working, you can't get away for too long because it's a cash business.
Yeah.
You have to recycle. In the laundromat business, where you don't have a card system, there's a change machine, and people put bills in the change machine, coins come out, coins go into the washers and dryers. Somebody has to take the coins from the washers and dryers and put it back in the change machine, or the customers don't have change to use in the machines. You can't ask just anybody to do that because that's cash.
Yes.
So you're beholden to doing that on a regular basis until the point where you either convert to card, or you have someone that you really, really trust, whether it's a family member or I don't even know if, your business, if you have a business partner, maybe, but it's cash.
Yeah. So if I give you 100K today, let's just assume I'm very rich and I give you 100K, having been in the real estate space and laundromats, which would you, if you could only pick one?
So in 2025, 100K is not going to... So, but the point is, if you're giving money...
Let's just say, okay.
If you're giving money, and I have a choice between the two, it depends on my needs. And so real estate is, as we discussed at the beginning, is a long-term game. in the short term, you should be cash flow positive. So there's something you're putting in your pocket.
Yeah.
But it's typically not a lot when you factor in the tax implication. So if your need is for sustainability in the short term and cash, I would say a laundromat.
Okay.
If your goal is for generating wealth and for you don't need cash flow to survive, I would say real estate.
That's a good approach. Yeah. Because real estate is long term, and that's where you build equity. But you need to be in for the long term. If you're in for the short term, there's a lot of fluctuations that happen. I know sometimes people bet on the hype because I know 2020, we saw how the markets in Toronto changed and people saw people making like 100K. Yeah. And some people jumped into real estate because of that. But it's for the short term, for long term rather. Short term is just hype, I would say.
Absolutely.
Yeah. So if someone is in their 20s, for example, what would you say they should focus on? This is just like your own opinion of you. If you could go back in your 20s, what would you have focused more on?
In your 20s, like go all out. You've got time to recover. If you have education behind you, you could always slip back into something.
Sure.
Because even though you don't have a job at the time, the experience that you are generating by running your own thing will be valued by some, not all, potential employers. And so if you fail, you likely have the safety net of family members if you're that young. And so you likely do not have the situation where you have dependents, likely don't have kids or a spouse or things like that. So that it's interesting that when we're younger, we want to hurry up and get everything all set up and secure and done the right way. But that's actually the time when you should be taking on the most risk because the risk reward scenario is in your favor when you're young.
Sure. Things are changing nowadays. I feel like a lot of employers now value entrepreneurship. And what you said is like, if it doesn't work out, then you can always go back to the 9 to 5. And I've seen a lot more employers start like adopting the modern mindset where they actually value this person because they understand that this person takes initiative. And that's what you need in the corporate world. You know, this person's going to figure things out because they did in entrepreneurship. And failure in entrepreneurship, I don't consider a failure really. It's you tried your best. Maybe things just didn't align.
Yep.
But you were bold enough to try.
Yep.
So I have a dilemma here. And I wanted to get your input because it is real estate related. So this is someone coming from the Black community, and we're talking about renting versus owning. Right now, their rent is around $2,500, but they know that if they decide to buy a house, it would end up costing them $4,000 plus up until $5,000 if they add maintenance and other property taxes and other things that come with home ownership. But they said that there's aside from the quantitative side where they feel like the numbers don't make sense, there's just the emotional side of things as well, where they moved to Canada from Nigeria and they just want to own a piece of the land here. It feels like you succeed or you're seen as successful when you own a home. So what's your opinion on that or like advice to that person in that situation? Especially because you're also a Black person, so you know what that ownership feels
so only the Native Indians own land. Not even the Crown technically owns land. It's really the Native Indians. We all pay tax on property, hence we don't technically own it because we're paying tax on it. There have been studies that demonstrate or show the difference between owning and buying. And owning, to your point, is emotional at times as opposed to rational. So if you were to take the amount of money that you were going to use as a deposit for a home, 40, 50, 100, whatever amount of money, and you invested that, and then you look at the differential between the rent and the mortgage payment, and then you look at all the housing costs. If you're not buying a brand new house, you're likely going to have to replace a furnace soon.
Yeah.
You're going to have to do a roof. You're going to have to all these things. You have to make just house maintenance. You factor all those things in, especially in today's time. It's not necessarily the best financial move to own a house. So if the person wants to feel good, they can run the numbers, they can do their homework and understand, does it make sense from a financial perspective? If it doesn't, then they can feel good about their decision to, or even if it's a forced decision in that they don't have the ability to own right now, they can feel good about their situation and knowing, you know what, this is actually the best thing. I was saving for a house. I only have 70% of the deposit. But if I actually take that money and invest it instead, I'm actually going to be ahead of the game versus behind. So I am not going to feel badly about this decision and this situation that I'm in. It's all about perspective and relativity. And so, again, to your point, there's an emotional attachment and a feeling of belonging and success that comes with reaching some pinnacle. Yeah. The pinnacle of home ownership can be overrated depending on the situation.
I agree.
So it's not the right thing for everybody, and every house is not the right purchase. So that's what I would tell that person is run the numbers.
No,
Take the emotion out of it.
Yeah, I totally agree with that take. It's like reframing it, because at the end of the day, what you want to build is wealth, and they're different vehicles. I know that society has just conditioned us to think home ownership is like the best, not the best, but it's like more celebrated. It's like when people buy houses, you see people saying congrats to them, but why don't we say congrats to people who buy their first stock? Or celebrate it. So I think that reframe is, put in the stock market if you feel like the numbers don't make sense. Well, thanks for that. I agree with that take. Thanks for watching, and don't forget to hit the like button and subscribe button if you're watching on YouTube. And if you're listening on any podcast platform, don't forget to hit the follow and give us a 5-star rating.